I'm Greg Hunter. Welcome to USA Watchdog. With us once again, a best-selling author. She penned this book. This is the paperback version of the hardcover. It's a best-selling book, All the President's Bankers. If you guessed, Nomi Prins, author, journalist, former big-time Wall Street banker. You guessed correct, Nomi Prins. Thank you so much for joining us today on USAWatchdog.com.
Thanks very much, Greg.
I read your 2016 preview, and you were one of these people that said, we're not going to have a crash in 14. We're probably not going to have a crash in 15. Boy, I read your preview in 2016. They wrote it the 5th of January. They published it the 5th of January. Maybe wrote it a few days before. But if it's not an all-out crash, it's going to be a real grind down in the markets. So your overview, just your overall overview, and we'll get into specifics. What's your overview of what's coming in 16?
Well, overview, and I think we've seen that so far in the beginning of 2016, and I do believe in this case in particular, the beginning of the year is indicative of the rest of the year. We are seeing declines everywhere, and significant declines. The U.S. stock markets are in a sort of 10%, some people call it direction. I call it just change in how we're going in terms of it. Now, it won't be a correction. It will actually be indicative of more downward spiraling to come. Last year, I talked about how it was a year of volatility, and a lot of that was because of all these fights between central banks and people wanting to find places to put their money, and the stock market was a big part of that. So were some bond markets. So were, before the beginning of the year, junk bond markets. But all of that has changed. We've seen defaults, declines, bankruptcies in companies related to the junk bond market. We've seen this turnaround of stock markets, and we've also seen a retraction in general of economies throughout the world, even though the United States president seems to think that the United States economy is doing fine. It's not. And all of this together is why all of the markets together are going to be in declines this year, as we've already seen.
All markets in decline this year. Ooh, that's one gloomy headline.
It will be in degrees. Some countries will obviously do better than others, and the U.S. will still continue, I believe, to outperform other countries, for example, in emerging markets in the South and in Eastern Asia, but that's because of what has accumulated over the years, which is that the U.S., because of the Federal Reserve, because of the policy of pumping the banks, of keeping money as cheap as it has been, which is near zero. Yes, they had a 25 basis points increase at the end of the year. I don't really call that a major policy change like some of the mainstream media types thought it would be. And the result of that has been merely a reaction of markets, including the U.S., to decline significantly. So it really did the opposite of what I believe the U.S. Federal Reserve might have hoped, not thought, but hoped it would do, and sent the market spiraling down, along with other economic and capital flow reasons that have also sent the market spiraling down.
Was there hope for this to build some confidence that, oh, wow, the economy really is really good, and the Fed's raising rates, and things are getting better because they're raising rates? And is that what you're explaining that?
Well, that's what I believe some of the headlines were saying when it happened, and some of the analysts who had been wrong all throughout the year. Of course, I had thought there wouldn't be any rate hikes last year at all, so I was wrong on the 25 basis points, but I don't consider it a hike. I considered it, and I say this in my piece, it was kind of a toe in the water, but not a toe in the water that indicates there's going to be a full body jump in following the toe. It's a toe, it's icy, you retract the toe, maybe you throw it in 3 to 6 months later to try it again, but it's not indicative of a raising rate policy. So yes, there was some assumption or conversation, I would have believed, at the Fed where they thought, well, if we give this confidence boost, and 25 basis points is tiny, it is the smallest increment possible to raise rates by, but if we do it, maybe function will follow the policy, and that didn't happen, and in fact it's been quite the opposite. It also indicated, and the Fed said this in their notes, their statement following that rate increase, nothing, because they say we are going to have an accommodative money policy this year. They use the terms, there will be a continuation of accommodative money policy. Accommodative money policy is cheap rates. It's the fabrication of ways to pump liquidity into the system that don't relate to actual profits or actual revenue or actual growth or actual economic stability.
Well, you also said, I got to stick up for you here because you said, well, I said they wouldn't do it. But you also said, but if they do, it'll have to be a one and done. Are they gonna? Is this their deal? I mean, Steve Leesman was on talking with one of the Dallas. I don't know. I think his name was John Williams at San Francisco, saying he thinks there'll be 4 or 5 rate hikes, 3 or 4 rate hikes. It sounds about right. And I'm thinking, after the last couple of weeks in the stock market, holy smokes! I mean, not good.
Well, not only the stock market, that's the thing that's most obvious, and that definitely has not been good. But also if you look at the bank liquidity, which was the whole reason that we've had 7 years, going on 8 now, of cheap money policy that started at the Fed and went around the world, is because banks need liquidity. And when they start seeing defaults coming in, when they start seeing their corporate loans not get paid or become delinquent in payment, they get scared about liquidity. They don't provide extra loans. They get concerned about the money that's going to come back to them. And those phone calls are going on with the Federal Reserve. So if we look at the primary focus of the Fed, which is to support the banking system, it's not to support jobs. It's not to balance inflation. Those are the sort of headline objectives that are part of what the Federal Reserve is supposed to do. But in reality, they're watching the markets and they're watching what's happening on bank balance sheets, in particular the big bank balance sheets of the United States, because they care less about the rest of the world, and they're not doing well.
So you're thinking that as the economy grinds lower, all these sections of the economy going lower, not just the stock market, but all these defaults start piling up, whether it's the oil market, whether it's commodities, farming, or whatever, wherever there's problems, manufacturing. You're saying as these defaults pile up, the banks are gonna take a hit, and that could bring the banking system down?
That could bring it down from where it is, absolutely. Because what they've done with that cheap money, what they've done with 7 years of a policy that was supposed to be an emergency fix to a financial crisis, right? That was the entire point of having 0 interest rates for the longest period in our history, and for promoting that policy across the globe in this race to 0. And there's still a race to 0. I mean, China is still reducing rates. Europe is still going to be at negative rates. They're still on quantitative easing. They've extended their quantitative easing policy from mid-2016 to fall of 2016 to now March of 2017. All around the world, there's this idea of continuing to pump cheap money into systems, into banks. In the United States, what has happened, and it always happens after cheap money periods, is the banks use that money to speculate and to lend to speculative endeavors, such as outside smaller companies within the oil and gas industry and so forth. And since oil has come down, that industry has obviously done much worse, and defaults have risen in that industry, but also in knock-on industries, in shipping, in mining, in all sorts of things that are connected to those sorts of commodity industries, and those are having defaults now. The S&P rating agency, as well as Fitch, put out reports at the end of last year where they have indicated an increase in delinquencies, an increase in defaults that are rising back up to pre-2008 levels. That's a problem to banks. So the Federal Reserve is going to be hearing this, if they're not at least looking for it themselves. They're not the most proactive bunch, but they will be hearing this from the banks, and the banks are concerned.
Could the oil implosion be the subprime crisis on steroids? That people say it's the investment in fracking and oil is way bigger than subprime ever thought of being. I mean, one headline came out. It was just since low oil prices knocked $125 billion out of the oil sector. Whoa! I mean, you look people stall with companies like BP laying off 4,000, 5,000, 6,000 people at a crack. And so, could this oil implosion catch the banks in a subprime type scenario, which is way worse than the subprime crisis?
Yes, it is worse in that it is global. What happened in the subprime crisis is that, and I talked about this in an earlier book, It Takes a Pillage, the subprime crisis was primarily constructed by U.S. banks and then distributed, those associated toxic assets and bonds distributed throughout the world. But for the most part, they were on a small amount of subprime loans in the United States that were leveraged a lot and redistributed a lot through various mechanisms throughout the world. So they started here. But from a global perspective, this is where oil comes in, because you have companies like Pemex in Mexico and Petrobras in Brazil, and different companies throughout the world that have been loaned to and for which the capital markets have gotten involved through U.S. banks. as well as European banks and so forth. So now they've distributed that cheap money to loans on a global basis. And that's why oil contracting and the knock-on effect that has to defaults on oil companies throughout the world and associated industries throughout the world has a far greater impact, not just on bank balance sheets, but on those companies and how much jobs they will have to cut and how many factories they'll have to close throughout the world. So it relates to a bigger economic depression than simply the leverage of subprime loans did, but it also connects to the very same banks.
Could this be 2008 on steroids?
It has started to be 2008 on steroids if you just look at the first 2 weeks of 2016. If you look at the number of defaults that have come in, if you look at the decrease in the stock market, if you look at, we won't see it yet this quarter, but we'll see a lot of losses coming into banks throughout the world as they report what's happening in this current quarter. So yes, I don't know yet if it's 2008 on steroids, but what it is 2008 on a global basis that has the ability to take down more countries more quickly than the subprime crisis did. Because, again, the subprime crisis was very negative to the United States. It went to Europe. It sort of went around the world, but it mostly was most acutely felt in the shortest period of time in the U.S. and in Europe. Some countries were shielded. China at the time was significantly shielded from the subprime and financial crisis that occurred in the United States. It took a lot longer and also related to issues in their own economy and how they deal with their financial system for things to get much weaker apparently there. And what China did, in fact, was, and one of the reasons it's tanked so badly, its markets have tanked so badly, is not just its economy, not just its reduced use of oil, but also the fact that it allowed a lot of speculation, a lot of foreign capital flows to come into the Chinese markets as of the middle of last year. The result had been more volume in those markets, and the result of that had been that when capital flows in fast, when hot money goes into a country fast, when the story is it's all positive and great for a minute, it comes out much faster. And that's what we're also seeing in China. It was a big story for a while, now it's not. Just like subprime toxic assets, before we call them toxic, were a big story, and now they're not. And just one final point on subprime for a second, because I was reading just now that Fannie Mae, one of the agencies in the United States that had produced a lot of the loans that were somewhat lined into these toxic assets and then redistributed by the big banks, they have $1.4 billion more of new non-performing loans just starting to come in. The banks will be repackaging and selling. So in subprime even, it's starting again. But that is minor, yes, to the oil story and to the default story and to the fact that cheap money from central banks has pumped a lot of these markets, and there's not a lot of space left to continue the same policies going forward. They will try, but it won't happen.
What you're saying, the world is much more exposed this time than 2008. Much shakier this time than 2008.
Yes, the world is fragile. It's a global fragility versus a crisis that emanated from the United States and went to Europe and less hit at the time the global economies. Now it is a global fragility.
Could this start off another the greatest depression ever? I mean, what you're describing in everybody should read your 2016 predictions, because there's not a single bright spot in there. And I don't mean to sound like you're a doom and gloomer, because you're not. You're one of the people that I had on that said, no, we're not going to crash in 13. We're not going to crash in 14. You were one of the bright spots, and boy, you have just, and you just lay it out, with analysis and analysis. That's just what you think. Here's why I think this. Here's why I think that. There wasn't a bright spot in there. Could this cause a global depression worse than any depression ever?
I think we're in a global depression in many countries. It's just that some of them, like the U.S., have managed to, because of the fabrication of money and sort of the appearance of figures, manage and help that the banking system has been given by the Federal Reserve to an extent that doesn't exist in other countries. It looks a little better here. So I do think we have a global depression. If you look at Brazil, which is actually in a technical depression, That's a big country. That's a country that has, very strong trade ties with China, has strong trade ties with Mexico, which has strong trade ties with us. That is the largest economy in South America. That is in a depression. Jobs are being lost. Their unemployment rate has basically doubled in the last couple of months, so it's accelerating very quickly. Defaults have have more than increased. Their central bank has been unable to stop the inflation to regular people's prices internally in the country. So those people are very much struggling, and there's no real light there. Mexico is a little bit better than Brazil because its inflation had been more contained than Brazil, but it's seeing the same impact from oil. It will see the same problems if the U.S. declines a little bit. They'll have a larger impact on Brazil. We see what's happening in China. They have an issue both from the standpoint of their central bank trying to do what the Fed did. Their 10-year bond rates are the lowest rate historically. They're trying to defend their currency, yet they're devaluing it at the same time because they need to be able to move more exports than they can and move them more cheaply, but also because the market, from a speculative perspective, is killing them. So all of these countries throughout the world, what is a depression, right? Your economy isn't growing, your corporate sector is imploding, your banking system doesn't have a lot of liquidity, capital is flowing out of your country, and people are losing jobs. These are classical depressions. Whether we define them as a contraction of GDP for 2 quarters in each case, in some countries there will be that. Some countries may fluctuate around a 0 or very small increase in GDP, but they're still heading in that direction because there has been no growth in the overall markets, and the speculative capital that's been swashed around to bolster stock and bond markets has been fabricated by central banks and knock-on effects of the financial system, not through the real productive elements of what should drive economies upward.
At some point, this comes back around and implodes. It just sounds like everything is imploding around the perimeter of the U.S., and at some point, doesn't it just black hole itself into the U.S. and we implode with everybody else?
Yes, because we are a trading partner with everyone else. We buy and sell products. We don't make as many products, but we certainly import products and we try to move products. And also we have an extremely large financial system from the standpoint of tentacles throughout the world, whether that has been through extending loans or through raising money in capital markets. Going back to Brazil again for a second, because I've been spending a lot of time. That's that's the current portion of the book I'm researching. We've had three of the same big 6 banks in the United States were involved in the 100-year bond for Petrobras, the biggest oil company in Brazil, which is mired in scandal as well as declines from the oil levels and so forth, and has taken down a lot of companies with it and will continue to do so. But 3 of our big 6 banks were involved recently in finding investors, and it was a 5 times oversubscribed bond to put money into that sinking ship. So they're going to be involved in lawsuits, and they are involved in a lawsuit now for Petrobras right now, which has been opened by the same judge who was involved in a lot of the subprime lawsuits. So that's another reason why this becomes global, because the same investors, pension funds, the Bill and Gates Foundation, they're slapping on lawsuits to foreign companies against the companies and the U.S. banks that asked for funds from them, that basically told them these companies were good investments. That's, again, a repeat story of what we saw in subprime, but on a bigger basis.
And your book title, you finally settled, you didn't know what it was going to be, but I think it kind of just evolved into The Artisans of Money. That's your upcoming book, The Artisans of Money, which I love. And it just says it's very simple, but yeah, it's like, people, artisan of money. But you must have heard Richard Fisher, the former president of the Dallas Fed, on CNBC a couple of weeks ago, saying that, we front-loaded the markets, and, quote, we created his words, front-loaded the markets, created a wealth effect. I mean, what, you admitted to committing fraud to juke the markets to enrich your friends? What? And then he says, people, the Fed, people just got too comfortable. They got lazy. People got lazy. They depended on the Fed. They got lazy. In other words, when this blows up, you get what you get. What did you think of those comments, being you're working on a book called The Artisans of Money?
Well, First of all, the Fed does not obviously operate in a vacuum. The whole reason why we've been on this artisanal or cheap money printing policy and all the elements of it, quantitative easing, buying bonds. When you buy a bond, you buy a government bond, it makes the rates go down. It's another way to keep rates low besides actually pegging them low in your monetary policy. Yeah, allowing banks to have reserves that you are paying interest on at the Federal Reserve that aren't being used for real lending to real people as opposed to speculative lending, which has currently been problematic. It's not like these institutions were forced to take the Fed's money, and it was not like the Fed provided it for no reason. It was a collaboration. And the Fed was created as a private bank. It is situated in Washington. It gets appointed its head by the president. It has to answer to the governors of the Federal Reserve System and some things with Congress. But the reality is, it's a bank that supports its members. Its members are the largest banks. The largest banks have the most shares in the Fed. It is a collaborative institution. And so when the Fed lowers its rates, banks don't just take advantage. They are part of the entire process. They need the cheap capital. The Federal Reserve provides the cheap capital. It's a symbiotic relationship. And so when I talk about the idea of artisans of money, that's something that's become a global phenomenon, is trying to basically provide money into your financial system that would not otherwise be there at such a cheap level, that would not be as available as easily for the largest banks. In the United States, they are member banks. In other countries, they have a slightly different relationship.
So the money's so cheap, people just like, sure, we'll loan you money. We'll loan you money 125% on a house. Yeah, we'll loan whatever money to whoever, whenever, because it's cheap. We're just going to create it. We'll make some money. We'll make some cash. And if it blows up, taxpayers will bail us out.
Well, it's some of that, but worse than that, it's also the fact that the banks have the ability, because they know if they need to speculate in a certain area, if they need to appear more solvent than they actually might be, that money has been available to them at such a cheap level in order for them to do that. They don't, when rates are at zero, they're not giving interest on savings accounts or giving interest on checking accounts. They're basically keeping the money. They haven't really changed what they charge on credit card rates or what they charge on personal loans or anything else. They basically kept that spread. And they've been able to use that money to, for example, loan to oil companies in Brazil or whatever it might be. They've changed their MO, and this is what banks have done historically. And all the president's bankers, I go through the periods where, okay, now we're extracting money from our domestic population. Now we're extracting money from an international population. Now we're extracting money from an international corporate sector. That's just what large banks do. They find the next place. And the more availability they have, the more easy it is for them to access that money cheaply, which is what the Fed has done for them, the more they will do it. That does not mean they're solvent. That does not mean they are healthy. That just means they have a really good source for that liquidity, for that capital, which they can then determine how to use in different perspectives, which tend to be risky. Because if you or I walked into, Vegas or wherever else, and someone said, here's some money, just go play. And yeah, you don't owe me later if you lose, or I'll lend you some more if you lose. Your propensity would be to take that risk. And that's how banks have been set up, and particularly when the Fed is a part of that process, that's how they've continued over these past 7+ years.
And finally, how do you protect yourself? I saved this for the last question, because you said the last interview that you were right about this. You should take money out of the system. I had somebody from Canada tell me that they wrote me and told me I got 4 banks and they wouldn't even let me take out the $2,000 at each bank, and now it's if I want to take out $5,000, I got to fill out a form. So they're actually putting in capital controls. How do you protect yourself? Do you do it with gold? Do you do it with cash? Do you do it with both? All the above? What do you do?
Well, I think with banks, just to add to that point, because I've had a lot of people question me from having said that over the year, and just to give some advice on that. Yes, if you want to take out a lot of cash from a bank, it is problematic, and you have to fill out, in some places, forms, or some places it's just tracked. But I think you do have to then take it out incrementally. It has to be part of your financial plan. So if you can only take out $500 at an ATM right now, and I can foresee a situation this year if things get much worse where that 500, could become 300. We don't know. But you take it out now and you sort of do put something aside, whatever your equivalent of a safe place is, so that you have that cash and so that you're able to kind of create a stockpile. I still think that is something that people should do. I mean, it's not like you're getting interest rates in these banks. There's no particular reason to use it except when you need to pay bills or use it for things that are actually about your personal economic situation. So that's one thing I think people should be doing anyway. With respect to gold, what's interesting about gold, and it's popped up a little in the beginning of the year, and now it's dampened a bit. Gold is related to the U.S. dollar more than anything else. At the end of last year, gold had gone down on an annual basis relative to the U.S. dollar because the U.S. dollar had gone up. It was completely a mirror play. It's generally somewhat of a mirror play, but it was a very mirrored play last year, as opposed to the euro relative to the gold prices, which were fairly stable. They were down a teeny smidge. They were pretty much neutral on the year. That only shows that the dollar had remained very strong. Why did the dollar behave very strongly last year? Exactly because of what we were talking about a few minutes ago, because other economies are weaker. So on a comparative basis, even though we were at zero interest rates and still near them, the dollar looked stronger. I mean, it's still a prevalent currency no matter what is going on the outside. To take away from the supremacy of the dollar, that is slow, and it's just, it takes longer when economies are faltering. It is still what many countries want to do. There's still a lot of collaborations being created to be outside the dollar, but in the meantime, the dollar has stayed strong. That's why gold had a bit of a temper on it. And I think that's why gold this year is still something to look at. It's still something that people should take as a percentage of their disposable investable income. Not to sell your house and buy gold, but your disposable investable income. I do think there should be a larger portion in gold this year than last year, but it's very important to be aware of what is happening with the dollar from an economic standpoint relative to other countries. You cannot look at gold in isolation this year, and you couldn't last year. I think I was on your show in the summer. I said we're going to have a gradual increase, which we did, and then we have that decline because the dollar strengthened so much relative to other currencies. So if one is to be in gold, one has to be looking at what the U.S. dollar is doing against some of the major currencies as well, and be cognizant of that. You cannot look at gold in a vacuum this year. There's too much going on in the global environment.
But you'd be adding to a position in gold, a physical gold.
I would be just physical gold, just allocated physical gold, but really slowly, and I would be doing it in a way that also is cognizant of what's happening with the U.S. dollar. Because a lot of people talk about how the U.S. dollar was going to decline and be smashed and all of that. And the reason I never said that was because of this relative strength. The fact that even the Fed had supported the appearance of support for the economy and the banking system by more and earlier than other countries did have an impact on the dollar, as also the fact that the dollar is prevalent as a reserve currency. But it is important to watch the dollar. It is, if you're going to add to gold, if I would add to gold, I would only do so in very small increments, and I would be watching the dollar every single time relative to other currencies. And the dollar looks like it's maintaining its strength, and other currencies are coming in, and other economies are coming in with significantly weaker numbers. I would be very careful about the amount of gold I would be adding at that time.
All right, Nomi Prins. She is the best-selling author of this, All the President's Bankers. This book right here, it's in paperback now. It's a hardcover too, but there's probably more books being sold in paperback now. And your other book, Artisans of Money, which is going to be coming out. When's that going to be coming out?
It'll be next year. I'm traveling around the world now. It's got some great researchers and meetings to do some very in-depth analysis for that book.
In 17?
Yes.
I think you had, 90 or 100 pages of footnotes for all the president's bankers? So nobody can say you're a slouch on your research, that's for sure. Nomi Prins, thank you very much for joining us today on USAWatchdog.com.
Thank you, Greg.